Hi everyone, I'm Laresa McIntyre, founder of Rockbridge CFO, and I am very excited to be bringing you the first in our series of webinars that we designed to help business leaders get a clearer view of the financial side of business. Today we're diving into one of the biggest traps that founders fall into, and that's trusting the P&L without understanding what information it leaves out. So this is something I hear from founders a lot. My P&L is showing a profit, but my cash is really tight and I don't understand why. Well, they need to realize that the P&L is built according to a set of rules called Generally Accepted Accounting Principles, or GAAP. And these rules were designed to ensure that there's financial reporting consistency across companies so that investors and lenders can make apples to apples comparisons. I'm sure you can appreciate the chaos that would ensue if investors had to make investment decisions or lenders had to evaluate risk if every company made up their own set of rules as to how their financials were prepared. So GAAP is really designed for reporting and not as much for managing your business. It's focusing on performance over time and not the actual movement of cash. And the reality is, for small businesses, medium-sized businesses that are growing, cash movement is very, very important. So when you look at the P&L, your numbers may be accurate according to the rules, but they're not always helpful when you're trying to fund payroll or make hiring decisions or even try to figure out the timing of a big expense. When your bookkeeper or your accountant at the end of the month gives you your P&L and says, hey, we made a profit this month, you can go ahead and do a little happy dance, but you just need to make sure you understand what it's really telling you. So hopefully by the end of today's session, you'll be able to spot where those blind spots are in your financials and adjust your thinking and your strategy to avoid being profit rich and cash poor. So here's what we're going to cover in today's webinar. First, we're going to look at what the P&L is actually showing you and what it leaves out. Then we're going to dive into the most common blind spots that founders run into, especially in fast-growing companies. After that, I'm going to walk you through what you should be tracking instead. What are the tools and insights that are going to give you a much clearer picture of your financial health? And then I'm going to share with you how you can start closing those gaps in your reporting. So as I mentioned earlier, the P&L is designed to show performance, not cash flow. They're prepared using an accounting method called the accrual basis, and specifically a rule known as the matching principle. That means that revenue is recorded when it's earned and expenses are recorded when they're incurred to create that revenue. Now you'll notice I use the words earned and incurred and not paid or received, and that was intentional because it's all about matching the revenue with the expenses that help generate that revenue, regardless of cash inflow or outflow. So this method is helpful for showing trends in profitability over time. It's great for external reporting, tax prep, even making comparisons between companies. But here's what you need to understand. The P&L does not reflect when money actually moves. It doesn't show you when cash comes in and cash goes out of your bank account. It doesn't account for things like how fast are your customers paying you? When does payroll come out of your bank account? When does the rent come out of your bank account? What are those irregular but critical costs like software renewals or bonuses that are going to be hitting your bank account? So even though a P&L can show you're profitable, your bank account may tell you something very different. That's why founders who rely only on the P&L to make decisions often feel blindsided because they're managing from a report that isn't designed to show them how much money they actually have to work with. So the first major blind spot I want to talk about are timing mismatches, and that's where the numbers in your profit and loss statement and the reality in your bank account are completely misaligned. This can happen on both the revenue side and the expense side. So let's look at the revenue side first. Throughout the month, you're going to be performing tasks that work for a client. And at the end of the month, you're going to create an invoice for that client, and you're going to book that invoice on your P&L as revenue. But if you've given your client 30-day terms to pay, the money's not going to show up for 30, maybe even 45 or 60 days, depending on if your client pays you late. So your financials are telling you you're profitable, but your bank account doesn't have anything to correspond with that. We can also see that on the flip side, on the expense side. Let's say you're working with a contractor and you utilize their services, and at the end of the month, they send you an invoice for the work they did during that month. Well, you're going to book that invoice on your P&L as an expense, but you don't have to pay it for probably 15 to 30 days. So even though the expense hits your P&L now, the cash isn't actually going to leave your account until next month. Here's another scenario that sometimes people forget about. Let's say you hired an attorney mid-month to do a contract review, and you know that bill is going to be around $500, but you get to the end of the month and the invoice hasn't shown up yet. Well, under GAAP rules, you're still required to record that expense even though you haven't received the invoice. So the bottom line is the P&L reflects activity within the business, not cash movement. In all three of those examples I just went through, something was recorded on the P&L, but absolutely nothing happened from a cash perspective. So if you're not tracking the timing of real cash inflows and outflows, you may be actually making decisions based on misleading data. The second blind spot is around how expenses are categorized and interpreted, and specifically when it comes to recurring and one-time costs. So let's start with something common, like annual insurance. So in January, you may pay $12,000 for the full year's worth of premiums. Well, that's an immediate cash hit. But on the P&L, according to the accounting rules, you have to smooth that out, and you're only going to record $1,000 worth of expense each month. So your financial reports make it look like the expenses are smooth and predictable, but your bank account says something differently. So unless you're tracking these lump sum payments separately, your forecast could completely miss a major cash outlay, and you won't realize the impact until it's too late. This can also happen on the revenue side. Let's say you're a business where people buy an annual subscription and they pay for it up front. Well, in the P&L, you're not going to recognize the revenue until you actually provide the services related to that cash. So if you were paid $12,000 up front at the beginning of the year, and your services are provided in equal increments throughout the year, you're going to record $1,000 worth of revenue each month on your P&L, but you're not actually going to get cash each month. You've already received the cash at the beginning of the year. Another issue is treating one-time expenses like recurring expenses and vice versa. For example, maybe you hired a contractor in April, and the invoice for that was $8,000. Well, if you assume that that expense is going to show up every single month going forward, then your forecasted cash needs are going to be overstated. And you might end up making decisions that limit your growth because you think you need more cash than you actually do. You may miss out on opportunities to do advertising or maybe do a trade show or something because you don't think you'll have the cash to be able to do that. You can also think about software purchases. Maybe you bought a license for a tool and you treated it like a one-time expense. But if it's got an annual renewal and you don't factor that into your future forecasts, you're going to be caught off guard when that renewal hits your credit card next year. So the takeaway here is you need to track and forecast those irregular, non-recurring, and lump sum items separately. Because if you don't, your cash burn rate is going to become a mystery. Some months are going to look great, others are going to look really tight, and you're really guessing what's real and what's noise. Now, the third blind spot is a really sneaky one, and I see it all the time with scaling companies. And that's the assumption that growth means you're winning. So on the surface, your top line's going up. Your revenue looks strong, you're adding clients, you're expanding your teams, you're signing new contracts. But what's happening underneath is maybe your margins are shrinking and your costs are rising faster than your revenue. So unless you're tracking it, you may not even realize it. Let me give you an example. Say you sign a big new client, but to service them, you need higher cost labor, or maybe the contract had tighter service level agreements than you're used to, and you need to dedicate more resources to it. Well, your revenue went up, but your gross margin per client actually went down. Now, if you're not familiar with the term gross margin, just a little aside here, gross margin is simply your revenue minus the direct costs tied to delivering that revenue. So those could be things like wages, licensing fees, infrastructure. So anything that's specifically related to the revenue, it's revenue minus those direct costs. That's your gross margin. Now, if you're not segmenting your P&L and you're not looking at client level profitability, then the erosion could be invisible to you. Your overall numbers might look good, but your most profitable client may actually become your least. So another trap is that spending tends to scale automatically. When you're growing, you tend to hire more people, you add tools, you sign leases, and those expenses can quickly outpace your growth. So without tight oversight, you may be building something unprofitable. The way to work around that is to track things like unit economics, customer acquisition cost, customer lifetime value, customer acquisition payback period, so that you actually know whether the growth that you're experiencing is healthy and sustainable. Bottom line, growth can mask fragility. It can give you a false sense of momentum, and in reality, you might actually be speeding toward a cliff. All right, so if your P&L isn't telling you the whole story, then what should you be looking at? Well, first you need to bring in tools where timing and cash flow come into the picture. And a great starting point is a 12-week cash forecast. This is going to give you a rolling view of what's actually coming in and out of your bank account week by week. It's simple, it's powerful, it gives you clarity, and it's especially good when you're making fast decisions. Now, we have an upcoming webinar that's going to talk about cash flow forecasting, so I won't delve much deeper into that, but I do want to make sure that you keep your eyes open for that. Another thing that you'll also want to make sure you're tracking is customer level profitability. Don't just ask how much revenue does this client bring in, but ask how much is it costing me to serve them. You may find that some of your biggest clients are actually your lowest margin because you haven't factored in things like custom work or added support or higher cost delivery. Another thing is your burn multiple, and that tells you how much money you're spending for every dollar of net new revenue you're bringing in. So if you're burning $30,000 to add $10,000 in new revenue, your burn multiple is a 3. The lower the number, the more efficient your growth is. So a burn multiple of 1 to 2 is good, especially if you're in early stage growth, and anything under 1 is exceptional. So that's where you want to aim. Similarly, customer acquisition cost payback measures how long it takes you to earn back what you spent to acquire that customer. So if it takes 3 months to recover that spend, great. If it's taking 18 months, that might be growing into a cash problem. Finally, don't stop at your forecast. You need to build a timing adjusted financial model, and that means aligning revenue and expenses based on when cash is actually moving, not just when it's recorded in the books. So for now, just remember, when you combine your P&L with these cash and margin insights, you stop guessing and you start bringing some clarity to what's going on in your business. So let me give you an example of what this looks like in real life. So I was working with a founder who was running a fast-growing B2B services company, and they were showing consistent profitability on their P&L. Every month looked healthy, revenue was going up, their gross margin seemed fine, and they felt really confident, but they were constantly tight on cash. And the founder kept asking me, why is this harder than why is this feeling harder than it should? And when we dug in, the 3 blind spots jumped out. So first, there were timing mismatches. They were invoicing on 30-day terms, but a lot of their clients were paying 45 to 60 days out. And their revenue looked great on the P&L, but the cash was lagging. They didn't have a formal process for collections, and they didn't assess risk when they were offering terms to their clients. So what we did was we put in a structured collections process, and we started running credit checks for new clients. And that helped accelerate their cash flow and reduce their exposure to late payers. They then had irregular expenses. They got hit with a $40,000 annual software renewal that they'd completely forgotten about. And since the P&L spread that cost out over 12 months, it didn't raise a red flag, and it nearly jeopardized their payroll. So what we did was we came in, we cataloged all of their vendor contracts for large one-time cash outlays, and we included renewal dates and cancellation terms. So if they didn't want to renew a contract, they knew when they needed to inform the vendor so that they didn't get stuck. We then added all of that to a finance calendar, and that made sure that nothing would catch them off guard again. The third thing that we found was their growth was hiding inefficiency. So they were onboarding new clients really fast, but it turned out that their newer accounts actually had lower margin because they had to engage more expensive labor to service those accounts. So their gross margin per client was falling, and because they weren't tracking that, they weren't able to see it. So when we came in and did the calculations, we found that 30% of their growth was actually unprofitable. So we reviewed and adjusted their pricing models so that they could protect their margin and ensure that any new growth was sustainable. So once we layered in a 12-week cash forecast, started reviewing collections and client profitability monthly, everything shifted. They avoided the near misses in funding their payroll. They were able to focus their sales strategy on higher margin deals, and it actually added 6 weeks to their cash runway in just 1 quarter. So their business didn't just look good on paper anymore, it actually ran better. So if any of this sounds familiar and you're wondering where your gaps might be, here's a few questions that you can ask your accountant or your finance team. These can help spark a conversation and really uncover some issues that before they turn into big problems. Now, if any of these questions are hard to answer or they haven't come up before, that's a signal, not a failure. It just means there's room for you to level up on how you're looking at your numbers. So how do you go about fixing the gaps that we've been talking about? Well, you don't need to throw your P&L out the window. You just need to layer in tools that are going to give you that visibility into cash, timing, and margins. So as I mentioned, you need to create that 12-week cash forecast and use it. alongside your P&L. So remember, P&L shows performance. Your cash forecast is going to show you what's actually happening with your money. And that one tool alone is going to help you avoid surprises and give you the confidence to make decisions. The second, start reviewing your collections and your accounts payable every single week. Don't let AR sit untouched until the end of the month. Knowing who owes you and when to expect it is critical. And likewise, you need to keep an eye on what's going out the door so you can avoid control the timing on your vendor payments strategically. The third thing is to build that timing adjusted dashboard. Even a simple spreadsheet works. The goal here is to align your revenue and your expenses to the actual movement of cash, not when it's booked on the P&L, so that you can get a true operating timeline and one that reflects how your business is running, not just how it reports. And if you adopt these habits, your numbers are going to stop being static reports. They're going to become strategic tools that help you lead with clarity and take smarter risks and scale with confidence. So let's bring it all together. First, your P&L shows performance, not liquidity. It's designed for consistency in reporting and not for decision making. It tells part of the story, but not the whole story. Second, growth can hide some serious problems. Just because your revenue is growing doesn't mean your margins are holding and your costs are under control or that your cash flow is smooth. If you're not digging deeper, growth may actually be accelerating your risk. And third, the best leaders are going to combine those P&L insights with their cash and timing visibility. So when you build things like that cash forecast, that client level profitability tracking, and real-time collections visibility, you're going to stop managing from the rearview mirror and you're going to start making proactive decisions with confidence. That's the real shift. From reacting to what's already happening to leading with foresight. And when you start operating that way, you just don't survive growth, you actually scale with purpose. I'd like to thank you for joining me. I know that you're busy and I really appreciate you taking the time out of your busy day to think about how you're using your numbers. If you leave this webinar with just one takeaway, let it be this. The P&L is a tool, but it's not the whole picture. When you layer in cash, timing, you get real insight on how your business is operating and you go from reacting to leading. If you want to stay in touch or you have any questions after, please feel free to reach out. You can find me on LinkedIn. You can visit rockbridgecfo.com to connect. And please make sure you keep an eye out for our next webinar in this series. It's all about building a simple, practical cash forecast that's going to help make decisions better and smarter every week. Take care and keep growing with confidence.